Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day to spend it with us. It is a blustery cold and winter weather-like day today in Toronto. So hopefully for those that are watching, hopefully you got to where you need to be safely. And for those that aren't in Toronto, well, hopefully the weather is good where you are. Hard to believe that this is the second last show for 2025. We will have one more show a couple of weeks from now, but it's unbelievable how time flies. And to look back and to see all the guests and how much information, all the questions we've answered over this past year is fantastic. On our next show, we're going to take a look back and a look ahead into 2026 to see what we believe 2026 will bring. But that'll be on our next show. On this show, let's put up our topics that we will be discussing. Here we have surprisingly strong Canadian Q3 GDP and November jobs numbers. Unlike the US, their government was shut down for, I guess, a month and a half or so. But the Canadian government was not closed, and we definitely received jobs and GDP numbers over the past couple of months. And yes, surprisingly, they were strong. So we're going to talk a bit about why those numbers were as strong as they were, and what does it mean for the Bank of Canada. Top 3 things to consider over the next 5 to 10 business days. As always, a popular segment on our show. 3 things that I think individual investors need to be mindful of before you make your investment decisions. Canadian bank earnings, to buy or not to buy? That is the question. And we're going to go over some of the bank earnings, but more importantly, talk a bit about banks, where they're trading today and how they are trading. Are they a good buy today? These are Canadian banks, big Canadian banks. Market looking for a catalyst to take the markets higher. What is the market looking for? Where is that next catalyst going to come from so that investors can get excited to bid this market up higher, even higher than it has been for the last, I guess, 6 or 7 months. We are coming into December near or at all-time highs. What can possibly take the markets higher? American USMCA review starts, or what we call up here in Canada, CUSMA, C-U-S-M-A. I guess depending on I wonder what they call it in Mexico, right? Depending on which country, I guess, is talking about the what used to be called NAFTA, the North American Free Trade Act. We're going to talk a bit about that because obviously negotiations are actually already being held. And we know that in the coming spring that CUSMA or USMCA could be up for a bit of a change, and we'll see what happens there and why that's just so important. Quick hits, 3 things that I've seen in the news recently that I think are actually quite important that I wanted to comment on. And last but definitely not least, your questions. If any of you have any questions during the show itself, please feel free to put them in the chat boxes, or if you have any questions, you want to send me a message on your own. Love to receive those messages as well. If I don't get to your messages or questions on this show, definitely we will get to them on our next show. So without further ado, let's move forward with our show. Yes, Canadian GDP and jobs numbers have actually surprised quite a bit to the upside. The numbers really surprised me as well. They're looking a lot better than what many had feared, right? We all were concerned with the tariffs and how long the effects of the U.S. tariffs would linger, would affect our businesses here. We are seeing definitely a big discrepancy between small businesses and larger businesses. Small businesses definitely taking it more on the chin than large businesses. A lot of unknowns, right? A lot of small businesses, the mom and pop shops, aren't sure where the next consumer is going to come from, where the next buy is going to come from. A lot of people have put buying on the sidelines a little bit. A lot of people are fearful of their jobs. A lot of people not sure, depending on obviously which industry they're in. They're not sure if perhaps changes will come to their business, and that affects their spending habits. And obviously, if the consumer has their spending habits affected, then it will definitely affect our small businesses. And we know just how important small businesses are to our economy. But the good news is we've seen some an uptick in GDP or growth in our country, and we've seen an uptick in jobs growth, and we've seen a downward, downward of about 0.4% on unemployment rate, which is really unusual. Normally, we don't see the unemployment rate fall that much. We went from 6.9% to 6.5% just in a month, which I think many are calling into question a little bit. Kind of surprised to see that sort of movement just in 1 month. But let's start with the GDP. And I guess for me, we can put up our first chart here, Canadian GDP by quarter. You can see in quarter number 2, we see red. We had a negative, I think it was negative 0.5% for the quarter. And you could see for quarter number 3, we jumped up 0.6%. Definitely unexpected. Many were actually fearful that we would see a second negative quarter back to back, which all of you now know, as I've said many times on this show, which would mean we are in a recession. But recession was not meant to be. Our economy seems to be doing just fine, at least with respect to the headline numbers. And we have actually moved away from the recession talk, at least for now. And looking at GDP and why it was so strong for the third quarter, we had to look at really 2 things: exports and imports, things that we import to our country and the amount that we export. And whenever you have a downtick in imports, so you're not paying as much because you're not importing as much, but you continue to export, that is a good thing for GDP. And that's exactly what happened this past quarter. Our next chart clearly shows this. You will see that the imports were significantly down. You can see there on the far right-hand side, the dark bar shows imports down by quite a bit, and our exports actually rebounded. If you look at the quarter before, our exports were significantly down and our imports were sort of flat. So that's really why GDP is up for this quarter. A good thing, don't get me wrong. Would love to see imports continue to be more normalized, I guess. Seeing a downturn in imports to that degree, last time we saw that was the first quarter, it looks like, or back in 2022, fourth quarter of 2022. So love to see imports, remain relatively stable and see a surge in exports. We didn't get that. Exports were only up a little bit, but it was the pullback in imports, and that's the main reason for our growth in GDP. And so, is that healthy? Is that sustainable? I'm going to say no. And to me, I'm not sure that we're going to continue on this growth projection that obviously this quarter has put us on. It'd be interesting to see what our next quarter gives us. Will it go back to where we were in quarter 2 on a negative number, or will it be a quarter 3 positive number, or somewhere in between? So definitely keeping an eye on the growth numbers. I would have loved to have seen a cut in taxes to help support growth in this country at our most recent budget. And I would love to have seen our Bank of Canada lower interest rates this morning. They did not lower interest rates this morning. They kept rates on hold, and we'll have to see what the Federal Reserve does at 2 p.m. this afternoon. Our next chart shows here Canada's unemployment rate. And as I said right away, if you look on the right-hand side, Canada's unemployment rate fell. It fell from about 6.9% to 6.5%. The estimate was actually for 7% unemployment. So that was a nice, pleasant surprise. Our chart that we have here, which shows us all the regions of Canada, you can see where the highest unemployment rates are, unfortunately for all of us living in Ontario. Ontario, being the largest province, actually has one of the highest unemployment rates, 7.3%. I guess you'd be hard-pressed to find a few others that are higher. PEI, 7.7. Newfoundland and Labrador, it looks like, is a 10.4, the highest. But overall, unfortunately, when you look at Ontario and compare it to Alberta, BC, and other provinces, some of the larger provinces, Quebec is another one, lowest rate in Quebec, as a matter of fact, at 5%. Obviously, unemployment rate for Ontario, not the greatest. And you look at some of the numbers that we received. We grew jobs in this country by about 53,000 for the month of November. 60,000 jobs grew in the month of October. So back-to-back really strong jobs growth. Unfortunately, a lot of those jobs are on the part-time side of things, not the full-time jobs. So that's a bit of a negative there. Good news is we saw a lot of part-time job gains for students, for the younger generation, and we know that a lot of students have been unfortunately unable to find employment, so that helped there. But again, you're looking at part-time jobs, and a lot of the jobs keep being grown at the government level. Government's growing jobs and adding to the jobs growth, whereas a lot of the private sector not growing jobs as quickly. So overall, jobs picture looks a lot better. We're seeing the unemployment rate in our country come down, but is the headline number look a lot better than when you start analyzing things underneath the hood? That is the question that many people will be asking. Our final chart or illustration for this segment, there it is. Bank of Canada, key interest rate versus inflation rate. And as I said, the Bank of Canada kept interest rates on hold. You're looking at a policy rate of 2.25. More importantly, prime rate. So this is the rate that if you go into a bank today that you can borrow at. Lines of credit, mortgages, things like that. Sometimes it's prime plus a little bit. Sometimes if you're lucky, it's prime rate minus a little bit. That prime rate sits in and around 4.45%. It has come down a lot over the last little while. I still would love to see it under 4%. Yes, that will stimulate the economy. I was asked on CP24 this morning when I was on at 10 a.m., would that overstimulate the economy if they continue to cut interest rates? In my opinion, I don't think so. I think our housing market needs it. I think we need more activity in the housing sector. I think the builders need more activity. And I think just in general, our businesses need to have some positives. They need more than what they have right now. As I said earlier, cutting taxes wouldn't hurt either. But overall, I just think that businesses, individuals, we need a break right now. You know, times are tough, costs are up right across the board. Wherever you look, costs are up. And I think if we can have more money in our pockets at the end of the day, that would go a long way to not only maintain spending and help increase growth in this country, but also, you know, take a little pressure off many of us right now that are feeling the pressure of higher costs. Top 3 things to consider before you make your investment decisions going forward over the next couple of weeks. Couple of things that I'm focusing on, actually 3 things that I'm focusing on for today. Federal Reserve interest rate announcement. We heard the Bank of Canada already this morning, just before 10 a.m. We will hear from the Federal Reserve at 2 p.m. I guess right now, we're looking pretty much that they're going to cut rates, probably about 85% chance that they will cut a quarter point. Key U.S. economic updates. We're going to get a bunch of updates coming actually next week. So after the Federal Reserve has their meeting, we're going to get jobs data, inflation data coming out. The last data we received is all the way back for September. We never received any October data, and the data we're going to get next week is going to be for the month of November. So that has the ability to affect markets up or to the downside. Looking for bargains even as markets they're at or near all-time highs. And this is an interesting one because with markets near or at all-time highs, you would think there really aren't many bargains out there. But I don't think that's the case. This is different. I think with the pullback that we saw back, let's say, middle of November, third week of November, that 5-6% pullback on the S&P 500, you saw a bunch of companies, I think good quality names, pull back in their share prices. And I think some of those names represent really good value right now. So I think there are bargains to be had, even in a market that is at all-time highs. Let's go to our first topic, or I guess first thing to consider before you make your investment decisions, and that's the Federal Reserve interest rate announcement. Our first chart that we have, very simple chart that we show many times. This is your target range for federal funds rate. You can see it coming down on the right-hand side. As always, as I always say, they have a range. We have an actual rate. They put it as a range, 3.75 to 4%. That is the range that it sits at right now, down from, you know, that 5.5% range not that long ago. So hopefully we can see the Fed lower rates. I think the market has priced in the lower rate already. And if we do not get a rate cut come 2 p.m., I don't think that's going to be a good thing for the stock market for today and for the foreseeable future. If they do cut, I think the market will just take it in stride and probably won't have much of an effect at all. Our next chart talks about probabilities, right? We've seen this chart before. Probabilities that the Fed will cut rates, 87.5%, so up a little bit from 85 that I mentioned. The chances that they're going to not cut rates, 12.6%. So highly unlikely that they will not cut. I think now the focus is now started to turn to next year. How many times will the Fed cut next year? And I've been hearing many talk about maybe 2 cuts next year. We know that President Trump is going to put a new person to head the Federal Reserve, and that person will probably be quite dovish. And obviously, he's going to put someone in there that he wants, and that he wants to cut rates next year. He's talked about that many times, that the Fed funds rate is much too high, and who he puts in that big seat will be under a lot of pressure to cut rates. So you can see here that more than likely the Fed will cut rates. I'm sure we'll get a couple of individuals dissent and not agree with a 25 basis point cut. I think Stephen Myron probably will want a 50 basis point cut, and you'll get a few others that may say that they shouldn't be cutting. But make no mistake, if the Fed does not cut, I think that'll be bad for markets. If the Federal Reserve does go forward with a cut, I think it'll be status quo and business as usual, as we say, and we just keep moving forward. So one eye has to be definitely kept on what the Fed will do come 2 o'clock this afternoon. Our next, topic, or our next idea that I think individual investors need to be focused on is this idea of key U.S. economic updates. And we're going to get a few of them coming next week. 2 of the most important ones, obviously, are the jobs and inflation. And that's what the Fed is going to be looking at. Unfortunately, it'll come after their meeting today. So it'll go a long way as to how how the Fed does early on in the new year, right? They're going to have this number, and then they're going to have a December number early on in January. And so very important what the data looks like. Our first chart for this topic, is monthly job changes. And you can see the job growth that we had. This is a September number, 119,000 jobs. The month before that, we lost jobs. And then we had a gain, and then we lost, and then a small gain. So it's been up and down, leading to more confusion by the Fed, leading to more confusion by investors not knowing what the Fed is going to do. But as I said, the odds right now are that we will see a cut. CPI data, our next chart, US CPI for September. We can see here, look at the CPI data. It's been relatively stable, right? 0.3, 0.2, 0.4, 0.3, 0.2 back in April, 0.1 we got down to in May. But when you look at CPI or inflation, you got to look at CPI, and you also look at PCE. Our next chart shows CPI out of the US, Consumer Price Index, and you can see 3%. We've been talking about inflation being at 3% for the longest time in the United States. The Consumer Price Index, which is one of the measurements. The second measurement that the Fed actually uses even more often is our next chart, which is PCE. And again, these are all a little bit outdated. They're back from September, but you can see that not only has PCE, the headline number, which is in gold, but the blue line, which is excluding the volatile food and energy, or core PCE, coming in at around 2.8%. And it's been there, as you can see, for a little while now. Hasn't really deviated quite a bit. Some people will say, well, that's not a good thing because they want to see it down to 2%. And when you look at the glass half full, versus half empty, at least you could say it's been stable and not rising, even with all the tariffs that have gone through this past year. So depending on how you want to look at it, right now, I think that the numbers coming out next week will give us some new perspective. This will give us the last couple of months a new number as to how inflation is doing and how jobs are doing. And this is the key economic data that I think you should be watching before you make your next investment decisions. And again, we like to look at the US versus Canada. because the US data seems to matter more for the stock market, both the TSX and the New York stock markets, the NASDAQ, the Dow, and the S&P 500. Our third topic that I wanted to discuss, and this is a topic about looking for bargains, even in a market that is, shall we say, fair value or at all-time highs once again. Love that Santa Claus and the reindeer there going on an upward trend. And that's really where the market has been, on an upward trend. But there are still some really good names and bargains out there to be had. Some of them I mentioned on our last show, and I'm probably going to mention them again today and mention a couple of new ones as well. Our first stock idea, again, if you can handle the volatility that these stocks bring to a portfolio, will be, yes, if you're guessing Meta, you are right. Meta, formerly called Facebook, right? Changed its name to Meta, the metaverse, a few years back now. You can see that since we've been talking about Meta as a bargain, stock price has actually gone higher on the far right-hand side, down from as high as $796 a share. Today, it sits somewhere around 650 or so, 655. Stock, I think, is a bargain at these prices. I've seen a lot of targets taking Meta shares over $800 a share, maybe as high as 850. And when you look at them on a PE multiple, definitely, as we talk about here all the time, about price to earnings multiples. So the price of the stock versus its earnings, Meta seems a lot cheaper than many other big cap tech names. Next stock that we have here, chart of Dell Technologies, another name I've been talking about. You can see the steep drop. And then again, ever since we've been talking about it, stock has moved higher. Maybe since we're talking about it, maybe if we talk about a few other stocks, those stocks will move higher as well. You never know, I guess. But Dell has moved higher as well over the last, let's call it, couple of weeks. And now Dell trading just under $140 a share. Again, Dell, big into the servers, AI. It's been a fabulous name to own. Got as high as about 180 and pulled back. And I think it's a pullback that you can continue to look at buying. So buy the dip there in Dell. A name, kind of different name, not a tech name, Blackstone. Blackstone is the largest asset manager in the world today. They manage a lot of money, a lot of pooled money that goes into real estate, for example, buying buildings and companies and other things. And Blackstone, once upon a time, a $200 a share company. Once again, nice rebound over the last couple of weeks into the mid 150s, but that got under 150 and as low as 140. And I think a good opportunity to look at. Let's take a look at a chart of Oracle, another big cap tech name. Look at that fall off in Oracle. And Oracle hasn't come back like some of the others as yet. Stock is still down well over 30% from the highs. Oracle was a name that everybody fell in love with their deal with OpenAI, parent of ChatGPT. They had a big deal with them. They still do. But for whatever reason, investors are calling it into question whether OpenAI will actually go through with the deal. Does OpenAI have the money to go through with the deal? And we're also hearing that Oracle, to continue to build out their data center, their artificial intelligence data center infrastructure, has had to borrow a lot of money. And that has been worrying a bunch of people. And last but not least, for this segment, a name that is not down as much, but I think a great bargain is Amazon. We have a chart on Amazon. Listening to the CEO of actually a piece of Amazon, which is their most profitable piece, which is Amazon Web Services, or AWS, their cloud business. The CEO there of AWS said they're going like gangbusters, booming business. And he was very, very positive. And listening to him speak and giving examples and talking about the future potential and future growth, I like Amazon. I think the stock is going significantly higher. It is down from its highs in the 250, 260 range. So not down as much as the others, down about maybe $25 from their all-time highs. But I think it has room to go even higher, make new highs in the coming months. So before we move on to the next segment, one of the things I just want to touch on quickly is that if you're wondering, well, Alan's talking about all U.S. stocks here. You are correct. I believe right now that the bargains and that we talk about when markets are at all-time highs reside more in the U.S. than in Canada. Obviously, our market is a lot smaller. Our market is built on banks. It's built on materials, gold, it's built on oil. And probably with the exception of oil, the other two segments of the economy have just been going like gangbusters. And we're going to touch on Canadian banks in just a moment. But overall, I think the bargains are more so in the US today than in Canada. And that's why, for those that know me well, we've been buying a lot of investments in the United States versus Canada. Not to say that, it's all going to go to the US, but definitely I wanted to point out that I believe that I guess there are better or more bargains in the US than in Canada. So keep an eye on these good bargains. And if you can perhaps buy some on the dip, I think that's a great idea. You want to also listen for what the Fed has to say, I guess at 2 p.m. And the key economic data that's going to come out next week. How is that going to move markets? Those are the three things that I think you need to focus on before you make your investment decisions. To buy or not to buy? That is the question. And I guess for a lot of Canadian investors, for their investment life, the answer for the most part has always been to buy. We've always bought up our Canadian bank stocks. Let's be honest, the five big banks, if you add National Bank as the sixth, they dominate the Canadian landscape. You have our five biggest banks right across the country. National Bank is kind of the sixth because it's primarily in Quebec. You'll find National Bank here in Ontario as well a little bit, but it's not right across the country. They've made acquisitions to try and be a little bit more, have business right across the country. But for the most part, you're talking five major banks. And when you have five banks dominating as they do, how can you not own a piece of our Canadian banks? And, their results that just came out were unbelievable. The wealth management division, capital markets division, just booming right now. And, yes, some of the banks set aside, I guess, some more money for, for potential bad debts or loans that are going bad. But the capital markets and wealth management division more than offset, the growth there more than offset any money that maybe banks set aside, any more money banks set aside for bad debts. And make no mistake about it, listening to some of the CEOs talk on some of the calls, for example, the CEO of CIBC, they talked about trying to have more business in the US, more business outside of Canada. And we know that the largest banks in our country, TD and Royal, have a lot of business in the US and outside of Canada. Scotiabank, probably the most international of our banks, has a lot of business not only in the US, but also in Central America, for example. And Scotia talks lately about having more business in the US and how that has made their bank a lot more profitable. So investing outside of Canada seems to be a bigger and bigger theme for our banks, and it is working. So let's take a look. Our first chart, Hamilton Enhanced Canadian Bank ETF. This is a chart I use often. This is how well banks have done. Look at all of our banks in one ETF or in one index. Look at the banks. And we go through some of the banks. And our first chart, CIBC Bank, it looks like the ETF. Not much difference. And most of these charts will look similar. Look at TD Bank, similar chart. We have it next. Pull up our TD Bank chart there. There it is. Almost looks exactly like the ETF. So you could see whether it's individual banks or banking sector as a whole, it's done extremely well. Our next chart here for Bank of Montreal is probably the only chart that is kind of different. Which chart doesn't belong here kind of game that we used to play as kids. And Bank of Montreal is the one that seems to have plateaued in and around the prices that it has, just about 3% off its all-time high. So we're not talking about any major pullbacks. Royal Bank, what a chart here as well. Our next chart, look at Royal Bank. It's done extremely well as well. And, looking at our last bank chart here is Scotiabank. Scotiabank now up to $100 a share. I remember when that stock was sitting around $77 a share. And investors were asking me, why are you buying it? Why are you buying it? And I said, well, with the turnaround, with the restructuring, I think it's a good idea to buy shares of Scotiabank. And if not only that, their yields were at 6%, where all the other bank yields on dividends, the dividend payments were 4%, 3%. So Scotiabank now with only a dividend yield of about 4.5%, because the stock price has gone up by so much. So if you're sitting there wondering, look how great the banks are doing, should we be buying banks? Well, in my opinion, I don't think that is true. I think the banks are perhaps fairly or even overvalued at this time. And so for me, I would say the banks, if you hold them, continue to hold them, maybe trim some profit from the top and move that money to other areas. But bank stocks in Canada right now are just too high. You have basically three major banks today alone reaching new all-time highs: TD, Royal, CIBC. Actually, four. Bank of Nova Scotia also hit an all-time high earlier in the day. And as I said, Bank of Montreal is just off its all-time high. So bank stocks just seem to keep moving to the upside. Their dividends that they're paying are fixed. So what does that mean? Well, you take the dividend of $1 or $2, whatever it is, and you divide that by the price, which seems to be keep rising. And what do you get? You get lower yields. So once upon a time where these bank stocks were yielding 4 or 5%, now they're yielding 3, 4%, not as enticing for dividend investors. So for me, I like the banks. I think you want to hold the banks, but you want to, keep an eye on them. Maybe on a dip, you could take a look at these banks, because right now, in my opinion, to add a lot of money to them or to make a new buy, I think they're just a little bit too expensive, and you may want to hold back on those purchases. Looking for a catalyst to take this market higher. And as investors, we always look for catalysts, right? What's the next catalyst to take the market to the next level? And when we don't find a catalyst, or unfortunately a negative catalyst, obviously that's not a good thing. And then investors get a little nervous, start selling, and selling creates more selling. And before you know it, you have a 5 to 10% correction. Now, I'm not saying that's where we're at today, but I think that has been the fear over the last, let's call it month or maybe a couple of months, that we lacked a catalyst to take this market higher. I think we could see perhaps maybe a small catalyst today if the Fed cuts rates, or perhaps, as I said earlier, that might already be built into the markets. And maybe it's a sell the news phenomenon at 2 o'clock this afternoon, or during Jerome Powell, the head of the Fed's press conference. Not sure how that will play out, but I don't look at it as a major catalyst. So if I don't see any major catalyst over the next couple of months, next couple of weeks, heading into year end, what do we have? Well, we always have seasonality. And we know that December tends to be a positive month for the markets. And so maybe we get a bit of a melt up into year end, maybe a bit of a Santa Claus rally at the end of the year. Our first chart shows the S&P 500 and just how much it's rallied off the lows in April. You saw a bit of a blip on the right-hand side there, a blip down. That was what happened in November. We also saw a bit of a downturn in October. But again, market bounces back very quickly. The buy the dip mentality is alive and well. Our next chart, we've seen this chart many times. It's a seasonality by month chart. And if you focus on the far right-hand side, you look at December. And yes, more often than not, December is a positive month. We have had, back in 2024, a negative December. Back in 2022, when the central banks raised rates 10 or 11 times, you can see here, December, almost 6% to the downside, and going all the way back to 2018, December was a horrible month, down 9%. But other than that, most of the time, December is a positive month. So I think what you're going to see is the markets, yes, gradually melt up into year end. I think the path of least resistance will be to the upside, in my opinion. And am I looking for any major increases in portfolios or in the markets in the last couple of weeks? I don't think so. I think for the most part, the gains that we've made this year, or that investors have made, are probably it. You might see a bit of a tick up, a little tick higher in the last couple of weeks. But for the most part, I think the market's going to basically just say, we don't see a big catalyst. And I think they're going to close up shop and go home, and just investors are just going to ride out the rest of the year flat to maybe slightly higher. So for me, seasonality is probably the one last catalyst or small catalyst that I think investors can hang their hat on. Otherwise, I would anticipate or have the expectation that markets will trend a little bit upward, but stay mostly flat for the remainder of 2025. The big talk, right? Trade talk between Canada, US, and Mexico, USMCA or CUSMA, I guess, depending on where you live, Canada first or US first. As I joked earlier on, what does Mexico say in Mexico? Will they put an M at the start of that acronym? I'm not so sure, but either way, a lot of conversations going on already here in our country, in the United States, a lot of politicians having conversations about what this free trade agreement will look like. And boy, is it extremely important to us here in our country. I'm definitely not surprised to see that many industries are calling for the President of the United States to strongly back another USMCA. Maybe there'll be some minor changes, but definitely they want to see things going forward. Obviously, in the US, the big complaint is that costs are rising. I know the president keeps telling us, keeps telling the US people that costs aren't rising, costs are coming down. Well, maybe that's true for oil prices or energy prices, or I should say gasoline prices, but pretty much everything else seems to have gone a lot higher in the last few years. He may blame the previous administration, which I'm sure has to take on some of the blame, but things haven't gotten too much better for the United States or the people living in the US. We have some headlines to show you from some individuals that we picked up on recently. Canada's Carney says Trump Sheinbaum pledged to work on USMCA, Sheinbaum being the leader of Mexico. Steelworkers tell USTR renegotiate the USMCA. The headline at the bottom, US producers warn Trump's tariffs jeopardize the access to Canada and Mexico. And last but not least, one that kind of scares a lot of us is Trump could leave trade deal next year, top trade officials say. And to me, that is the most important headline out of all those, because as our next chart shows, if the United States were to leave the USMCA or CUSMA deal, what would that mean for Canada? Let's put up our next chart, which shows US imports from Canada by tariff provision. So very important here. The dark part of each bar is the part that is free from tariffs, free from duties. And you can see how big that is. The yellow, general provisions, historically likely largely duty free. So even the yellow is duty free. And you only see that little light blue, which has the tariffs applied to it. And that's why Prime Minister Carney has said that Canada has been the best with respect to tariffs being applied to our goods. We've had the least amount of tariffs as a percentage of our goods that we send to the United States. We're tariffed the least out of any major country around the world. And that's because of our free trade agreement. But if that free trade agreement goes away, what will that mean for many of the products, as you can see, that we send down to the US? Will that dark blue part of the bar chart be cut in half, maybe cut by 2/3, or removed altogether? Will they tariff everything going into the United States? I hope not. Obviously, I would be surprised if we saw something of that magnitude. But I can tell you that many states, many people in the United States do not want to see that happen and want to see an extension of the free trade agreement between the three countries. So we're going to have to keep our eyes and ears on the negotiations that are already taking place. And I think as we get closer and closer to the spring, it will garner more and more of the headlines. Don't be surprised to hear that the president is walking away at some point. That seems to be what he does. He likes to put the pressure on before he negotiates. So let's see what happens with the negotiation between Canada, Mexico, and the US. Hopefully, we can get an agreement, and hopefully we can get agreement soon. Quick hits, 3 things in the news that I wanted to comment on that I think are actually quite important. First one, China trade surplus tops $1 trillion for the first time on non-US growth. If you think about how much trade was done or has been eliminated between China and the US, it's quite a bit. Yet they were able to top $1 trillion surplus for the first time. So what does that mean? Well, like our country here, like Canada, they're starting to make deals outside of the deals they're making with, or that they have with the US. In my opinion, I think that's a negative for the US. If more and more countries start to make deals amongst themselves and leave out the US, where is that going to leave the United States? It's going to leave them out on the outside looking in my opinion. Canada's doing the same thing with Prime Minister Carney forging relationships elsewhere. Trump green lights NVIDIA H200 AI chips to China if he gets 25% cut. Funny story, because is this a security issue that the US doesn't want to let China gain access to these chips? I guess the security issue goes away if the US gets a cut, 25% of the profits. So that's an unusual thing, not something we've seen in the past. Our third quick hit, Trump unveils $12 billion in aid package for farmers hit by trade war. And so, yes, if trade or tariffs is not affecting the United States, why do they need to put together such a large package? So let's go through our first quick hit. China trade surplus reaches $1 trillion. Let's look at our first chart. And again, this clearly shows that China, as well as other countries, are starting to, I guess, move on, get on with life after the United States, or at least with more limited trade with the United States. And you can see this chart. It is by far the largest number we've ever seen. First time crossing the $1 trillion mark. So China, like other countries, are forging new relationships. Again, bad for the United States. The United States wants to be the dominant currency, the dominant provider, the dominating exporter, importer for the rest of the world. What does this mean for them if other countries are moving away? Definitely not a good thing. Our second quick hit here is that Trump greenlights NVIDIA to send the H200 AI chip sales to China if they get a cut of 25%. Now, I will also tell you that they also approved AMD, another chip maker, to send chips to China also for that same deal of getting 25% of the revenue. Our first chart we have is NVIDIA Corp. And you can see how NVIDIA has been faring. For all of you that own NVIDIA and think NVIDIA has been a fantastic stock to own, it has. But if you look at the chart, it hasn't really done much since late summer. It's peaked a little bit beginning of November and then pulled back. So for me, NVIDIA has sort of been flat, hasn't really grown an awful lot. AMD, our next chart, also perhaps will benefit from chips sold to China. Chart looks a little bit better, surged after October, pulled back, halfway through or 3/4 of the way through November, and has moved higher in December once again. So the interesting thing about these chips that have been approved by the United States, China is already saying that they may restrict these chips or put a partial restriction on the chips. So the US is saying, yeah, we'll agree if you give us a cut of the profits, but China may not agree, and it may be blocked on the Chinese side. So even though NVIDIA and AMD might have a bit of a good deal going here, the stock really didn't move much higher. Both stocks didn't move much higher because now investors are saying that China may be the one to block the sale of these chips. Our last quick hit, Trump unveils $12 billion aid package for farmers hit by trade war. We can pull up our one chart for this topic, and you can see here that China has made few U.S. soybean purchases. Soybean purchases was a topic of conversation in the last negotiations between U.S. and China. You can see for 2025 how few soybean buys have been made by China. And you can see right now, China is playing hardball. They're not so quick to buy. They may say, yeah, we're going to buy, we're going to buy, we're going to buy. And the president comes away saying they have a deal. But the proof will be in when they actually make those buys. And for the year 2025, those buys have been basically flat. And so that is obviously the worry for farmers and other farming products, other things that the farmers send all over the world. Obviously, China is a big destination for farmers, and so very important. And that's why President Trump has put together a $12 billion aid package. So a couple of ideas, a couple of things in the news that I think are important for individual investors to understand, and perhaps I wanted to comment on. And every day there seems to be new headlines coming out of the White House, and definitely not a shortage of those. So we'll keep an eye on more quick hits in the future. But for now, I think those are the three quick hits that caught my eye for this show today. So now the part of the show where I take a question from the audience. And a lot of the questions I take are usually ones that I get over the last couple of weeks since our last show. But the question we got today, I think, is actually quite good because it talks about some of the things we talked about on today's show. And it reads, should we buy Canadian stocks or Canadian mutual funds since the trade war with the US? So should we be more patriotic with our investment decisions? And I've said this on previous shows. I agree with trying to buy more Canadian products, buy closer to home, helping out our businesses, our mom and pop small businesses, mom and pop shops here, local shops, trying to help them while this trade war is underway. However, unfortunately for investors, as I've mentioned on our show many times, Canada makes up a very small part of the world's wealth, whereas the United States is a $30 trillion economy. The next largest economy is China, which is under 20 trillion. 7 companies in the US make up over 20 trillion. There are a lot more companies, there are a lot more investment ideas, and there are more sectors that have many different opportunities in them, like pharma, like tech, like retail. And so unfortunately for us, we don't have as many opportunities here in our country. And as I said earlier in the show, we're pretty much at fair value, maybe even overvalued on some of our tech names and some of our bank names, and even maybe some of our oil names with respect to oil prices falling, now getting close to $55 a barrel WTI. So for me, I would look at where the best value is. If it's international, that is where you need to go. We're hearing our Canadian banks, as I said earlier, go more outside or invest more outside of Canada, go more international. Canadian mutual funds are investing over 40% outside of Canada. As long as they have 50% invested in Canada or 51%, they still can be called a Canadian mutual fund, but you're seeing a lot of investment outside of our country. And that is for good reason. Markets around the world have been doing really, really well over the past 5-10 years. And I think investors need to keep that in mind before you make your investment decisions. So with that, I want to thank everybody for joining in on and watching our show today, our second last show of the year. Wow, how time has flown by. We will be on air one last time for 2025. Yes, on December the 24th. So Christmas Eve, we will broadcast at 12 noon, as always, across most of your social media channels. And I just want to wish everybody, until then, a happy investing.